In this video, I'll talk about what really influences the mortgage rates that you pay, and we're starting right now. Hey guys, Elliot here. So what factors determine what rate you will pay when you take out a mortgage? While it sure may seem like lenders unilaterally determine mortgage rates by pulling the strings behind the scenes, in actuality, rates arise from an interplay of both external economic factors and the borrower's personal qualifications. Lenders then process these two sets of data and set their final rates based on all of the above plus the return they need to have in order to turn a profit after accounting for risks and costs, as they are, after all, a business. Let's take a closer look at all three factors in a bit more detail. When it comes to external factors, perhaps the biggest is the current yield on bonds. There are of course many types of bonds, but lenders focus on mortgage-backed securities or MBSs. Their rates are closely tied to those of the US Treasury bonds, also known as T-bonds, particularly the 10-year Treasury note. Mortgage-backed securities usually trade at an interest rate premium to the T-bonds, and this difference between Treasury rates and MBS rates is called the mortgage spread. Lenders usually add a margin to the MBS rate to come up with the rate they charge for a mortgage loan. Now, of course, bonds don't perform in a vacuum. Their yield is influenced by the state of the economy, Federal Reserve policy, investor confidence and sentiment, rate of inflation, financial markets, government policy, and a host of other global and political events. Finally, something to keep in mind, this approach is what independent non-bank lenders, including wholesale ones, follow. However, if it's a bank that originates your mortgage loan, a different mechanism is used to set the rate because of the fact that banks can retain loans on their balance sheets. They usually use what's referred to as a cost of funds plus bank margin approach. They too, however, are influenced by roughly the same factors I just listed. So once the external factor, which you can't do much about, is accounted for, the lender turns to the borrower and their personal and some property qualifications. Here, a number of factors that are mostly under your control will be looked at. Some examples are your credit score, your loan to value ratio, which is really just the amount of your down payment, your debt to income ratio, the loan amount you're asking for, closing costs, discount points purchased, and property type, among other factors. It is here that you can most influence the rate by having your finances in order and having low debt and no financial problems. Finally, when the external factors are combined with your personal ones, we get to the lender's own internal policies and criteria. The fact is that even with all else being equal, rates will vary between lenders, and this is why it pays to shop around or have your mortgage loan officer shop your application to numerous lenders on your behalf. This is all due to differences in lenders' pricing strategies, cost structures, margins, and risk appetites. So as you can see, what determines mortgage rates is not a simple answer, and a lot of ingredients combine for the final rate that you will be presented with. Okay, that was a quick explanation of what goes into your mortgage financing. As always, if you enjoy this content, please do like and subscribe, and I'll see you in the next video.